Hey, hello, how you doing? It's been a while. Hello, hello, this is Bookie's Revenge. We are back with another $500 Rags to Riches 5-year episode of the series episodes. I forgot my intro. Anyway, here's the guest star for today is Guitar, because I didn't move my green screen the right way. It's been a while. So I've been super busy behind the scenes, unfortunately, so I haven't been able to make a bunch of episodes. I kind of missed the entire week last week. So we had some drawdown in the market, then we had some recovery. So I just kind of want to do like a status update check-in, as well as introduce the strategy that I'll be building into on the larger portfolio in the near future, as well as some exciting news. So this one should be hopefully a relatively shorter episode, but you know how I get sometimes when I just ramble. So let's go ahead and look at the account. So this is the smaller, the actual Rags to Riches $500 portfolio. And you can see that most things, so here on this column I have the open P&L and then I have the days P&L. So you can ignore this right column. It's just for my intraday stuff. But you can see here on Tesla, for example, it's 54.54 for the day. Currently back around 12.42 as far as percentages. And, we can see we had some drawdown and then some recovery. So this whole swoop is kind of irrelevant, right? Because for Tesla specifically, I don't really care too much about the share P&L. It's a nice to have, but it's not a requirement because my primary purpose for this position is to convert cash into dividends for a lower tax rate and keep some resource for potential tax loss harvesting towards the end of the year if I need it, right? Because remember, we pay like 15% roughly on qualified dividend income, and we can deduct 100% of losses for capital losses up to a limit. So anything that I don't use at the end of the year, I'll probably just offload on Tesla, realize some loss, and just kind of bring that back to par. So easy enough little position there. And of course, I'm offsetting the risky nature of that with more stable stocks like Johnson & Johnson, Main, Schwab, JAPQ, and we're good to go. So let's go ahead and take a look at this. So Neo obviously is another one. It's been climbing for a little bit, kind of climbing out of the hole, so to speak. And that's a large part of these two specifically are because of Tesla. Tesla had earnings. They got some pretty good catalysts. They're going to try to set up in China. Not really things I care about, but then again, I don't have to, right? Because I've got the dividend stuff set up. So I did grab some more Johnson & Johnson, and this is kind of what I covered in the stream on Friday. I have my live stream. So if I go to stockanalysis.com and we look up Johnson & Johnson, for example, and then we click on dividends here, you can see that the May 20th is their next ex-div date. And May is this coming month. So on, Wednesday, I'll have my $500 contribution. So I just wanted to make sure that I picked up a little bit of Johnson & Johnson before this ex-div date. Because remember, this is a quarterly one, so I don't have to buy this every month. But I do at least want to get a little bit more each time there's an ex-div, just so I can continue to grow this yield. So I grab some Johnson & Johnson, and I'm going to also do the same kind of research into the other ones. I believe, most of these are monthly, so I don't really have to worry too much about that. But I just wanted to make sure I got in on Johnson & Johnson. I'll probably grab another one here, maybe tomorrow. I don't know. We'll see what the stock does before I make decisions. Not that it really matters too much. I just don't want to try to get filled after hours with a 8-cent spread. So maybe I'll grab some, maybe I won't. Either way, we can see here that I grabbed some more Johnson & Johnson. I grabbed some more Tesla, I believe, earlier, 2 weeks ago. And for this one, it was actually kind of interesting. I think Neil might be a little bit upset with me, but I grabbed this at 12.88. And all I did, right? I don't remember exactly what time frame I think I was on the 30-minute when I did this. If we zoom out, right, we could see we had some sell-off. And if we kick it up to like the 4-hour, you can see here, price wasn't really down here for a long time until right after IPO, right? So this is kind of the only reason I actually bought this. It was just around the IPO kind of minimum, right? And that typically naturally sets up a sort of a bracket. And so I kind of knew it was time to start looking for a buy. But ultimately, all I did is go to the 30-minute, and I looked for an engulfing candle, and I bought. That's the only reason I got it at 12.88. It wasn't anything magical. It was just close enough to the IPO bottom, and I saw an engulf around morning time into lunch. So nothing special there. It just happened to go up drastically afterward. And by drastically, even that is very small potatoes in comparison to the 5 years worth of trading. So 25%, not bad. but we're still negative, or I am. So as far as the share P&L goes, as far as the overall position goes, I'm sitting pretty, right? Because I've got all those dividend payments sitting on top of this. So I've got about 251, I think, in dividends for the portfolio. And I think a good chunk of those, I think about 190 or so, are just from Tesla. So overall, I'm okay. Even if I sell this for a loss right now, for a realized loss, I'm still net positive from this entire position. Okay? That's, again, that's a nice to have, but it's not a requirement because, again, the primary purpose for this is just converting cash and getting those realized losses when they occur, okay, or when I need them to. Because, you know, as you make more money, you're going to have to look for ways to offset those taxes because the IRS kids are going to have an excellent Christmas morning if you don't. So as far as JABQ, it's just kind of hanging out. A lot of these are just kind of recovering with the market, so there's not a whole lot we can do as far as speculation goes. Schwab, Ladder, for example, Maine, they're all just kind of doing the same thing. Neo, this call, I'm actually considering adding some more to this just because I believe we're going to have a pretty good push into the summer. But we got to clear these, you know, previous highs and all that good stuff. So I think we're only one or two good catalysts away from a nasty run on Neo. It's just a matter of what happens in the EV space before that happens. So either way, I'm okay down here at 14 bucks anyway, and I've got 18 contracts. So that's good, right? It's good enough for me. So let me switch over to the other account here really quick because I don't want to ramble too much because I do have an important thing I want to teach on this. And I've already touched on it before, but I just want to illustrate kind of the importance of being diligent with it. So if I look, you know, Neo up here on the top, and you can see I've got my, if I switch this over here, not a whole lot going on after hours today. Now we do have a lot of big earnings this week. So if I switch over here and I look at the earnings calendar, you can see we've got a lot of tech earnings this week. So, you know, it's going to move the market one way or the other. I think we're going to see the biggest moves probably tomorrow after hours and then maybe Wednesday. So we'll see. Either way, we also have Fed Powell talking this week. So, you know, rising above all that crap, all the noise, we got a pretty good setup for this week. So for Neo here, we're still about 14% down on the shares, but the covered calls, again, have racked in thousands and thousands of dollars on this. So I'm not too worried about these. If it goes up and I get a sign, I'm still selling above my cost basis and I'll still be net profitable. So I believe this will continue up, but I can't predict that because that is not sustainable. So I do have a couple small speculative positions here. I've got NXPL. It's just got to pull up and get a little bit of volume on that. RWOD, same things I think I covered last episode. I think it was my last episode. It might have been on my live stream Friday. And PaxMed, of course, is one of our favorites. So what you may realize that I've done here, and I'll kind of dig into this here in a moment, is I've got a sell order here 1 cent above my average, and I also have a second sell order up here. Okay, and I'll walk through that in a second here. But for SPCE, okay, I've got a May contract. I've got October contracts, and I basically just have orders to close these when they're appropriate. So it's no different than what I did on WBA, but the only difference here is that for SPCE, I'm looking to average down. So I'm looking to acquire more shares, so I'm selling cash secured puts in addition to the covered calls. So if I just collapse all that, it doesn't really matter. But for WBA, right, if I look at my orders here, you can see WBA, I bought my 2 contracts back for $1, the May 10th contracts, and then I immediately sold May 31st $20.50 contracts for $5, okay? And what that allows me to do is it allows me to move my strike down, but I'm still above my cost basis. So if I do get a sign I have to sell my shares, I'm still making a net profit, and I potentially have that realized loss, which will go into my tax deduction bucket for the month. So I won't be breaking anything too horribly here. I'm just following the plan, and I'm still making a profit overall. And of course, all this as well, Neo is kind of doing its thing, right? As far as these sell orders, okay, so if we look at PaxMed, right, let me just convert this down to one chart here. I'll pick up the time frame too, so it's not so choppy. And we'll turn these extended hours off, okay? So what you can see here is impulse, retrace, blah, 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 blah. All right, we're kind of compressing. It might break up, it might break down. I don't really care. I just need this to get to my break even and then just, 0.16 cents above that pretty much. And then I'm going to reduce that position, okay? So if I pull over, let me just duplicate this tab here in this other window, sorry. So just ignore the price here. So if I can get the price to just pull up to my break even in this position, okay, 78.94. Okay, well, let me just duplicate this tab here. I'll start fresh. Okay. Let's say that I plan to have $6,000 in this position right here, for example. $6,000. All right. So if I wanted to make $6,000 into PaxMed, okay, and I bought and bought and bought and bought, and let's say my average here was, down at 78.94 after all my buys, okay, and then I reduce this at break even, okay, and this, for those who have been in the PB community long enough, know that this is my seedling strategy, and you guys are going to learn what that means here in a moment. It's good. All right, so if I reduce this at break even back down to that first buy, okay, and then this becomes my first buy at 78.94, okay, and I'm allowing for 20% drops between my buys, okay, my next buy would be at 63.15, which is down here. I'll just erase all these. 63.15, okay, 0.6315, okay. So essentially what I'd be doing is taking my first buy, which was somewhere around here. I don't remember exactly where it was. And I've averaged down, averaged down, averaged down, reduced, averaged down, averaged down, right? So if I reduce down to all but that first buy, okay, first buy, that allows me to essentially move my first buy, which was up here somewhere, down to here. And then I've taken all that extra money that I put in, in these areas or wherever I put them, and I'm moving them back out of the equation. Let me just stretch this out so I can move it. And I'm just setting those back on the side so that I don't have to have them exposed to the market, okay? And by doing that, I'm allowing myself to regain I'm prioritizing having leverage over my cost basis or my average, okay? And the reason I want to do that is because in this kind of market, or especially when you're dealing with lower float stocks and things that have massive upside potential, but they also have high risk, you really want to be favored to the downside. You want to be on top of your risk management. You want to have control over your average, and you want to be cash heavy in a lot of cases. Now, there's obviously a right way and a wrong way to do this, and a lot of people end up getting hurt because they put their money too close together or they buy in too soon. And one of the easiest ways to kind of force yourself to slow down, which I've probably covered in recent episodes here, but I've definitely done it on live streams, is just to force yourself to space those buys apart. So if, let's say, for example, I want to do a $6,000 position. Let me just move this over here. I'll just do PaxMed, right? This will tell me the max, the market price and all that good stuff. If I place 5 buys, okay, and they're all 20% apart, that allows me to have 80% drawdown max, okay? And most people be like, oh, well, 20 times 5 is 100. Yes and no. So when you buy the first buy, that's 0% drawdown, right? Because you're just at break even. Second buy is 20% down. Third buy is 40% down. Fourth buy is 60% down. The fifth and final buy is 80% down. So you don't get the full 100% range. And that will likely never happen unless the stock delists. And at that point, you got bigger problems. So in this case, right, if I buy my first buy at 78.94, if I reduce this position down so that my first buy position is 78.94, or if I just stopped out right now and I bought, right, and the price happened to be 78.94, whatever the circumstances are leading up to it, that would be my first buy, right? So if I then wanted to place a second buy, it would need to be at least 20% below that, or 10% or 15%. I'm personally just choosing 5 buys at 20% each to get that 80% max drawdown. The price would need to move down at least $0.1579, which is this number minus 20%, to the next threshold, which is 63.15. So 63.15 would be where I'd need to place that second buy at most, at the highest price. It's got to be below that number. All right. So as I've discussed in previous videos, when I want the price to come down below this line, I want to look for that engulfing setup. And then, and only then, will I consider placing a buy. So what I can do is wait for a red candle, place a buy stop order 1 cent above the opening price of that red candle, and then the order will automatically fill when the price goes back up above that candle. Otherwise, if another red candle forms, oops, right? If I get another red candle, and let's say I get another one and another one, right? I could just follow that price down, okay, until the price finally pushes up. And then at that point, I will have moved my potential buy from here, okay, all the way down to here. So I'm giving myself that much more leverage over my average, okay? And my first buy, the position sizing is what makes this so potent. It's not just the, spacing your buys apart. It's the fact that you're saving the bulk of that push to the downside for those later buys, okay? And essentially, this is just a modified martingale. So anyone who's familiar with the gambling realm and anyone who's familiar with statistics probably already knows that this is stacked against you, which is why we capitulate the number of buys, and it's also why we increment the dollar sizes the way that we do, and we also prioritize reducing the risk exposure, not just holding it all in the hope that it pushes up, okay? So in this case, if I were to set aside, or if I were to allocate $6,000 for this, okay, my first buy would be $375, okay? That would allow me to get 475 shares. That would be the cost. That would be the total invested at that point, total number of shares, share average, and share target. And the target is just 10%. So this is where the magic comes in, okay? Because I'm allowing myself to have an 80% drawdown, and I only ever need the price to get back to my break even, I have very high probability of being able to make that happen on most trades, right? The obvious exception is when things get delisted, and that's why it's important to do some due diligence. But if you do this on stable stocks, you'll have a very good time in the market in most cases, because you only ever need it to get to break even to reduce your position back down and reset your buys essentially, and just free up that capital so that you have maximum leverage over your portfolio. And then beyond that first target, you only need the price to go up another 10% for you to lock the profit. Okay, so in theory, your profit should always ever only be 10% of this, your first buy, because if you're reducing effectively at that break even or just above it, and you're setting a 10% profit target, you're just taking this number, which is always ever going to be your first buy, and you're dividing it by 10. And that's your profit on every trade you take where you follow this particular approach. Now, it's not the most effective, right? Or it's not the most efficient, okay? However, there are modifications we can make. When it comes time to reducing your positions, you can push this number above your break even, and you can lock in a little extra profit along the way. Each time, let's say maybe you reduce it 5% up, or maybe you increase your profit potential, and that's how you maximize those reversals. You can make those numbers bigger, and then you can use that to open more positions. Okay, and this is kind of where the seedlings come in. So if you think about this first buy, this initial $375 at this price is a seed. Okay, these subsequent buys are to water that seed. They give it nutrients. They add to it in a way that allows it to dig deeper. Okay, as soon as it breaks above the ground, you want those seeds to fly away and go plant somewhere else and germinate and grow other trees, other plants. Okay. And the goal there is to have your own little forest at some point of money trees. And in order to do that, you have to follow a system consistently, and you're going to eventually have issues, obviously. Now, if you took an 80% drawdown and you put $6,000 in, you're not losing 80% of $6,000. You're losing 80% of this, 60% of this, 40% of this, 20% of this. And then, of course, a very small piece of that, because your stop loss will be set immediately after the final buy. Right? So hopefully that makes sense. I know a lot of people see 80% drawdown and they think, oh my God, I'm losing, $4,500 or whatever that number is. It's not the case. Really what you're doing is you're just compartmentalizing the portions of that 80% to the increasing dollar amount. So increasing dollar sizes, decreasing risk range. Okay. And I want to have a nice graphic made up for you guys, ideally an animation at some point, to kind of illustrate how this all works. But I think once a lot of these covered calls and stuff are out of this portfolio, this larger one, I'll probably just start showing you guys how to do this on a nice, clean, sterile account, similar to how we did it with the covered call stuff. But now I'm just waiting for these to clear out. So I'll probably just roll these out because we're still right around entry, so I'm not too worried about it. And the really cool part is, if you look at this, right? Sorry. If you look at this number right here, this 15,000, that's open P&L. And most of that is from this and a little bit from that. Once that 15,000 adds in, that's easily a 20+% increase on the entire portfolio. So we're right around break even. All we're doing is just enduring drawdown. And we're just collecting passive money as that happens. And then once price goes back up, rocket's engaged. It's awesome. Now, mixed in with that, we can do things like this. We can draw down on speculative positions, and I'll do that. I'll just walk through a very clean, very compartmentalized set of speculative positions, and I'll start doing that probably going forward. Probably next month, I think. Once the first of the month rolls around and I start rolling some of these contracts out, we'll get these closed out. Yeah, I think I'll just start doing that, and you guys will hopefully be able to see that side of it, so that it's something that you can use and kind of speed up your profit taking. Because I know that the passive income is great, dividends are great, tax advantages are great, but there's more that we can do, and we just need to focus on prioritizing risk exposure and risk management, and not so much about trying to be right and guess which way things are going to go, because that's where people get hurt. So I'll just show you guys, you can pretty much be brain dead in the market and still find success. You just have to do it the right way. Obviously, there are no guarantees, and we do offer a lot more in the premium side of things as far as optimizing that profitability. But I just want to show you guys that it is still possible in this market, 2024, to have 2020 style returns, as long as you have a 2020 style system. And you just have to understand that there's different strategies to take when the markets are in certain states. And right now, election year, we've got craziness happening. We're a change of season, change of sector rotation. This is kind of where we want to start gearing into. We endured a lot. We did the hedging. Market's starting to have some recovery, starting to show some volatility. This is where we want to start using a strategy which optimizes profits on volatility. So I know I'm rambling quite a bit, but for those of you who are familiar with this strategy, you guys will see it, and you guys will remember it, and hopefully you guys will enjoy it. For those who are new, feel free to stick around. I will walk through this strategy step by step, a little bit less chaotically, and then we will be able to rock and roll. I apologize for not being able to make a video this past week. I've just been so insanely busy on the back end, and I also want to give you guys a heads up on May 22nd. I'm going to start getting some dental work done, so I may sound funny. Basically, it's going to be every other Wednesday. They're going to be ripping my face apart. And I just got some bad genetics and from being homeless and stuff. So now I'm finally in a position where I can get that addressed, and we're going to do it all at once, and it'll be fun. So I may not be able to make too many episodes there. If I do, I might sound like a whoopee cushion, so hopefully not. But we'll see. We'll see where it goes. I will catch you guys later. Thank you all for watching, and enjoy your week. Be safe, and keep an eye on these earnings, because it's going to be chaos. All right, bye.